Hey everyone, George here. So if you're a California contractor paying $40,000 a year or more in state taxes, there's a good chance you're overpaying the IRS. So we're going to go over the pass-through entity tax election again, as we did in a prior episode, but more specifically this time, we're going to cover how it interacts with the new tax laws that got passed here in summer of 2025. So without further ado, let's get started. So as a quick refresher, in 2017 with the Tax Cuts and Jobs Act, there was a $10,000 limit placed on the state taxes that you can deduct on your personal return, which becomes problematic when you're paying a lot of state taxes through your S-Corp, your partnership, your multi-member LLC. So now with the OBBBA, that cap got raised to $20,000 if you're a single filer or $40,000 if you file a married filing joint. But most contractors who have, a business that is thriving or they scale, they pay way more than $40,000 in state taxes. So even that new $40,000 cap does not replace that PTET tax strategy entirely. So as a quick refresher, the PTET allows the entity, the S-Corp partnership or multi-member LLC, to pay state taxes on behalf of the owners, and then take that deduction at a federal level. So it's moving that deduction upstream to the business and give a credit for the state taxes paid to your state tax return on your personal side. So in essence, you end up getting a deduction for state taxes paid. So a lot of people are asking, if the new cap is $40,000, do I still need the PTET election, the PTET tax strategy? My short answer is almost always yes for California contractors. So let's run a few scenarios down here when it would still be beneficial. So in scenario one, you have joint filers paying $60,000 in California tax. The SALT limit lets you deduct $40,000. The PTET lets you deduct all $60,000. So, there you're getting an extra $20,000 deduction right off the bat. And with a 35% federal rate, that's a $7,000 tax savings right there. So scenario two, you pay $120,000 in California tax as joint filers. So the SALT cap is going to give you, again, just $40,000. The PTET deduct allows you to deduct the full $120,000. And again, so that results in an extra $80,000 in tax savings with the PTET tax strategy. And at the 35% marginal tax rate, that's another, $28,000 of savings right there. Now, conversely, if you have scenario three where you pay $35,000 in California taxes, so now you're below the $40,000 SALT limit, so your PTET might not provide any benefit. So you could skip PTET in lower income years. It's hard to say, a lot of times, in construction, it's feast or famine. So it's hard to say where the year will end up. So that's why I always recommend to my contractor clients, make the election in June. Let's just get it in there. And we can always change our mind later and decide to not elect it fully. However, to have that option open, it's like if your last 2 quarters of the year are finished strong, you get some big projects, it's going to result in a big tax savings. And here's the thing, you can think that you're paying less than $40K in state income taxes. However, let's go over everything that could be included in state income taxes paid, and you'll be surprised that it could easily exceed that $40K. Number one broad category is all state income taxes paid. So that can include income taxes withheld for, as shown on the W-2, income taxes paid with estimated tax payments, the pass-through entity tax itself, state income taxes paid with your return for a prior year in the current year, and state income taxes paid with an auditor notice in the current year. Number two broad category is any local city or county income taxes that you pay, if that's applicable to you. I've seen this happen more in the New York area, not so much. It doesn't really happen in California. Number three, real estate property taxes paid. This can include property taxes on your primary residence, your vacation, your rental, and any supplemental property taxes that you might have received a notice for and paid for in the current year. This can also include any personal property taxes paid, your DMV registration fees, but it must be based on the value of your property and charged on an annual basis. So again, these things can really add up, and you'll be surprised you might actually be paying easily more than $40K in state taxes, especially if you have a profitable business. So again, my personal recommendation is if you pay over $40,000 in state taxes, you absolutely should make the PTET election. It's going to be to your benefit. If your state taxes that you're paying are between $20,000 to $40,000, you should run the numbers, but I still highly recommend that you make the PTET election. And if you're paying less than $20,000 a year in state taxes and you don't anticipate, a growth of your business in the current year under any which way, circumstance, shape, or form, then PTET in that case would be unnecessary. But most of the clients that I talk to, most contractors, the $40,000 is not a high bar for the state tax between all things considered. DMV fees, again, property taxes, your estimated tax payments, a spouse's W-2 withholdings, all these things aggregated, $40,000 is an easy line to cross. So I always recommend to make this election to utilize this tax strategy. There you have it. I hope you found this helpful. Click like, subscribe, turn on notifications for any updates, and I hope to see you in the next one.